Welcome to the Debit This, Credit That podcast with Wheeler Accountants located in San Jose, California. In this podcast, we discuss how to solve accounting challenges in both your personal life and your business. We take an energetic, tech-savvy approach to solving accounting challenges that steal your focus and your time. Now, on to the show with your tech-savvy accounting experts, Matt Wheeler and Michael Bryant.
Well, thanks for joining us again. This is episode number 8 with Wheeler Accounting. We're talking to Matt Wheeler today, talking about Roth Retirement Accounts and the 6 key considerations. Now, Matt, a lot of people have heard the term Roth, but what's going on here?
A Roth account, Matt, it's a retirement account that you can use where it has tax-free distributions in retirement. And when you mention tax-free to people's eyes light up. They get extremely excited because nothing's better than tax-free income, right? Or tax-free distributions. The problem is there's a lot of factors that go into deciding whether a Roth account is the right thing for you, right? When you put the money into the Roth account, you're not getting a current tax deduction, okay? So it's after-tax money going into the Roth. You're forgoing that current tax benefit. You got to think about what your current tax rate is. And you also got to think about what your tax rate is going to be in retirement when you're going to withdraw that money in a regular account and pay tax on it. And there's all kinds of considerations like that go into it. So while a Roth account seems sexy and attractive on the surface and sound like a great idea, there's a lot that goes into making a good decision to make sure that you're saving a lot of money over time.
Well, you already hinted towards some of the questions you should ask, but what other questions do I need to ask myself to see if this applies to me?
There's a couple big questions you got to ask that are really important to help us determine whether a Roth account's the right fit for you. Number one, what's my current tax bracket? Am I in a high bracket? Am I in a middle bracket? Am I in a low bracket? Number two, what's my bracket going to look like in retirement? Or maybe a better question is, what are my sources of income going to be in retirement? And then we can kind of work into what your tax bracket looks like under current law, right? Are you going to be in a high income bracket because you have a lot of income that's going to kick in retirement, like pensions? Or are you going to be in a middle or low income bracket where you're drawing more on principal from investment accounts and that kind of thing where they don't generate any taxable income? Another thing you want to take a look at is what's the total value of your estate. There are some estate planning tools we can use with the Roth, option for retirement accounts. So you want to take a look at that. You also want to take a look at, what the current value of your accounts are. How much are we looking at converting to Roth? Can we, or moving into Roth accounts if they're already in pre-tax accounts? Do you have a lot in pre-tax retirement assets? Do you only have a little bit? This kind of plays into your sources of income in retirement as well. So those are a lot of the key questions you want to ask yourself in the beginning, and that'll help guide us through the process of deciding if a Roth account is right for you.
Well, who does this normally affect, though, Matt? I mean, I think that I've asked myself those questions, and I'm still a little unsure. Who else does this affect?
Matt, is going to affect anyone who has earned income where they have the option of putting money into one of the retirement accounts available to them, whether it be a traditional IRA or 401k through a qualified plan at work, or the Roth components of either one of those as well. It also could impact anybody that basically already has pre-existing retirement accounts that are pre-tax, and they're thinking about moving some of those into Roth assets. So it affects anyone that has a retirement account or is able to contribute to a retirement account.
Okay. And why is this so important? I mean, I like how you opened this up by saying, Roth conversions sound really sexy, but why is it important for people to think about these 6 key considerations?
It's really important because it can carry enormous tax consequences. When you look at your total tax burden over, your career and into retirement, the choices that you make on how you fund your retirement accounts and which options you choose can dramatically impact how much taxes you pay over that lifetime of, that entire time horizon, right? So what we want to avoid is paying a lot of tax by moving stuff to these tax-free Roth accounts and then pulling it out as tax-free income in retirement when you don't need tax-free income in retirement, right? So it's really important to make sure we're taking a look at the whole picture, looking at all the facets, and then determining what's the best long-term tax strategy for you.
Okay, so we know what the problem is and what questions you should ask, who this affects and why it's important. So what do you do about all this, Matt?
Well, you go through some of the 6 key strategies we're going to talk about.
Okay, well, let's jump into these 6 key considerations for Roth retirement accounts. What is the first one, Matt?
first one for me always is the time value of money on current tax savings. I was just talking to a client this morning, couple, they're making $500,000 a year, so pretty good income, right near the very top bracket. And one of them had half her money going into regular 401k at work and half going into the Roth version. And when you're putting money into the Roth 401k at work, you're not getting any current tax deduction for that amount. So, if you're funding $10,000 into the Roth 401k at work and you're in the top bracket, in California, you're almost at 50%. That's $5,000 of tax savings that you're foregoing to put money into the Roth account now, so you can get tax-free distributions, way down the road, and tax-free growth. And that $5,000 is worth a lot of money, more than $5,000. It's the time value of that being able to compound over time and investing that $5,000 now. So, that's why if you're in a high bracket, you want to take a look at the regular 401k option, not the Roth. The time value of money savings can be substantial.
Okay. Well, so you're talking about the time value of money in the current one. What's number two?
One of the second considerations is the tax bracket discrepancy you're going to have between when you're working now and, in the future, we're going to be drawing down on these accounts. A lot of people tend to think that, tax rates can only go up, or that I'm always going to be in a really high tax bracket or something. But going back to this couple I was talking to this morning, they're in the top bracket right now. Chances are likely that in retirement, they're not going to be in the top bracket anymore. Typically, your sources of income are going to be your retirement accounts and then some investment income in retirement, as well as some of the liquidity that you already have, where you're drawing down some principal on your accounts, which is not taxable income. So usually your income is less. Maybe your sources of taxable income are actually less, and some's coming from tax-exempt sources, and you're in a lower bracket. So, putting money into the Roth account in the 39.6% bracket and not getting a deduction, and then pulling it out when you're in the 25% or lower bracket where it's tax-free, that doesn't make a whole lot of sense to me, where you're foregoing that 15% differential right there. I'd rather have you put money into the regular 401k in the top bracket at 39.6 and then pull it out at 25%, and you've already saved 14% right there off the bat.
Yeah, that makes a lot of sense. I guess, taking that sort of long view is one of the great values that you bring to your clients. So let's talk about number three, when things maybe aren't going as well.
Well, yeah. Number three, is in the low income or loss years, you want to take a look at, your options here for Roth versus regular. And it doesn't necessarily have to be things not going well. It could just be you're earlier in your career and you're not making a whole lot of money. If you're just starting out in your 20s and your salary is not that large and you're in a lower tax bracket, the Roth is a good option for a lot of reasons. You don't need the tax write-off because you're not paying much income tax anyway, and you have a long time for that account to grow tax-free and compound and have tax-free withdrawals in the future. But for some people, later on in life, they find themselves in situations where they switch jobs, where they, get laid off and are looking for work for a period of time or something, or they're just looking to take a little break or hiatus before they go back into something else. And, they have a low income year, or maybe they started a business and they have a lot of losses from the business, or they sold a rental property that had a big loss, something like that. Some one-time event or something where the income drops substantially from the normal income levels they're used to. And then in those situations, we want to take a look at maybe, now doing the Roth account instead of the traditional and foregoing that tax break because you don't need it as much. It's not worth as much. Or you also want to take a look at doing what's called a Roth conversion, which is where you take an existing pre-tax retirement account, like a qualified plan, like a 401k or an IRA, and you convert a portion of that account into a Roth version. What happens when you're doing that is you're recognizing income on the amount of the conversion. So you're accelerating some taxable income into the current year by doing the conversion. But if you're in a low income or loss year, then you may not have much tax hit or impact, if any. And therefore, it's kind of like there's no downside to doing the conversion. You're switching those pre-tax funds to after-tax, tax-free funds with no current tax consequence. Now you get the best of both worlds, or all worlds, really. Imagine if you funded the account in the high income years, and got all the tax write-offs those years. Then you had a big low income year and converted the entire thing to Roth tax-free. Now you got tax deduction going in and tax-free coming out and no tax cost in the middle.
That sounds ideal.
Doesn't always happen for everyone, but when it's available, we want to spring and pounce on that, right? We want to take advantage of those situations as they arise, and that's why we try and stay in front of our clients throughout the year, and especially before year end, because Roth conversion is like a timing thing. You have to have it done by the end of the year in the current year to have it count for that year. If you miss that window, you blew it,
Right.
and you can't go back and do it. So very important. We're staying in communication. We're staying on top of that, and we're taking advantage of these opportunities when they arise.
Well, we're halfway through the 6 key considerations for Roth retirement accounts. Number 1 was the time value of money on current tax savings. Number 2, that your tax bracket discrepancy between your high earning years and retirement. Number 3 was those times where you're not making as much money, even if you just started out or just started a business. So what's number 4?
So the fourth one's what I like to call past performance is not indicative of future results. We've all seen the infomercials and commercials on TV where they talk about some investment opportunity and they add that little tagline at the end, basically letting there's no guarantee that what happened in the past is going to happen in the future. And that's a real important consideration for the Roth accounts, because the whole Roth thing is, part of the current tax code, but that's not a set in stone, document. The tax code is a living document. We get new tax acts every time. We get new Congress every few years, right? So, there's no guarantee that what's available for a Roth account now is going to be available in the future to you. I got a lot of clients who sometimes want to look into the Roth account because they're absolutely convinced that tax rates are going up in the future, the debt load in our country is too high, yada, yada, yada. Not that I disagree with any of that, but then the same people want to turn around and pay tax now and do a Roth conversion, and they're relying on our country to keep the same tax code in the future, and there's no guarantee Congress isn't going to come back and claw back the Roth thing or limit it or, handicap it or do whatever to really, bring down the effectiveness of the Roth account and not help you out as much. There's just so much unknowns with that, One of the retirement plan experts that I know, this guy was a president of the American Society of Pension, folks and actuaries, right? He's testified before Congress on pension reform.
Wow.
He's convinced that Roth is not going to last in the future, that at some point they're going to claw back the Roth thing. And he has 0 of his own personal assets in Roth accounts. That's what he tells me. So, I don't necessarily – I'm not – no one has a crystal ball and knows exactly what's going to happen, right? But I think it's important to hedge our bets. A current tax deduction now for going into a regular account is a guaranteed. You're going to get it this year. That year's going to pass and be gone. And then if we can do things like convert to Roth in the years where we don't have any tax hit and there's no downside, then we can convert to a Roth. And, if they end up clawing back the Roth and saying we can't do it or whatnot in the future, or part of it's taxable or whatever, we didn't really pay anything to get into the program, right?
Sure.
What we don't want to do is pay a high tax cost now to do a conversion or something or fund the Roth account, and then we end up not getting the benefit down the road and we get basically screwed, right? Yeah. So, a lot of people don't think about that, and I think it's a really important consideration in the whole Roth conversation is this going to be around in the future?
Well, okay, so let's break this down and unpack this a little bit, please, Matt, because how do you figure this stuff out? How do you figure out conversions and what's right and the timing, and help us with that?
So we can run all kinds of calculations to do a conversion, and I always think back, this really blew up in 2010 when the rules changed. That's when, before 2010, you couldn't do a Roth conversion if you had more than $100,000 of income. So, a lot of our clients here, especially in Silicon Valley and other places that are high earners, the Roth conversion was not an option. It wasn't something that was on the table to consider. When the rules changed in the Great Recession, anybody could do a conversion. This opened up the Pandora's box of, Roth options to people available to do the conversions and, turn previously pre-tax retirement accounts into these new tax-free Roth accounts by paying all the tax up front on the conversion. And there were even special rules where you could spread that tax hit out over 2 years, so you didn't have to pay it all at once. And you could choose to pay it from inside the Roth account, which is not a good idea, or pay it with money outside the Roth account, which at least preserves the value of the Roth account. So, that was something that came in around 2010, and we had all these calculators we had, and you had all these different options you could look at, and all these variables went into the calculation, right? What's the current value of your account? What's your current tax rate? What's your tax rate going to be in the future? What's the return going to be on the account in the future? And if you think about the things I just said. I said future a couple times, right? And there's a multi-variables going into this conversion calculation. And the bottom line is we have no idea whether it's going to be a good idea to convert or not, because those variables can, vary dramatically. I mean, we have no idea what your future return is going to be in the account. We don't know what your tax rate is going to be in retirement in 20 years, So it's too difficult to predict. And, we have a lot of clients that want to go through this exercise, and I basically flat out tell them that, I can tell you whether to convert or not, and neither of us is going to know whether I'm right or not until either one or both of us is dead, because, it can take 20, 30 years to figure out whether it was a good decision or not based on what actually happened. So, there's no perfect calculation for the conversion. That's why I tend to shy away from Roth conversions unless we have a situation where we're in a low income or no income environment and we're not really having a tax hit by doing so.
Gotcha.
Then it becomes kind of a no-brainer.
Okay. Well, what's number 6 then? Because we're already at the 6th solution.
The last solution is just that, a Roth retirement account can be a good estate planning tool. So, a regular IRA or 401k plan has mandatory distributions that kick in at age 78.5. You have to start drawing down the account at that point in time. And if you pass away before you've drawn down the account entirely, there's a named beneficiary or beneficiaries on the account, and you transfer that account to them. They then can withdraw the funds from the account, and they pay income tax on the withdrawals as they occur. So pretty straightforward. The advantage of a Roth account is that, one, it's not subject to the RMD requirements or minimum distributions. So you actually don't not need to withdraw any money from the account during your lifetime. So, age 70.5 comes, but if you live another 15, 20, 25 years, that account can grow pretty substantially over that amount of time, tax-free, and you can then pass on that account to the named beneficiary or beneficiaries in the future, and they're not going to pay any tax on the amount they inherit. So if you're in a large taxable estate, or you're in a situation where you're always going to be in the top bracket because you have an income stream that's going to always put you in that situation, we may then take a look at doing Roth conversions, paying the tax, with the eye towards the long-term planning of having these assets passed on to the next generation tax-free, allowing them to grow tax-free as well. But those tend to be limited circumstances. Doesn't come up quite as often. For most people, we do some of the techniques we discussed previously, some of the first 5.
All right. Well, do you mind walking us back through those 6?
Yeah. So you got, taking a look at the time value of money, right? Considering that a current deduction now is worth more than a future deduction of the same amount. So you want to take advantage of the regular options when you're in a high income environment. You want to take a look at the tax rate differential between now and when you're going to be in retirement. If you don't have a lot of sources of ordinary income that are going to kick in retirement, like a pension or something, where you're going to possibly be in a lower bracket, it's not that bad to do a regular IRA or 401k now and then take the money out as taxable in retirement because you're at least saving on the differential there. 3, you want to take advantage of opportunities, low income years, loss years, things like that. The gap period between when you retire and when you're going to withdraw the account. We call it the retirement gap. We did a whole podcast on that already. You want to do a Roth conversion during those periods where you're not paying any income tax, right? 4, you want to consider the Roth may not be around forever, so don't put all your eggs in one basket, right? 5, there's no perfect calculator, so we can try and run the scenarios, but again, you want to try and pick it when you're having very little tax cost to the conversion, so it's not a lot out of pocket. And then number 6, the retirement planning tool or estate planning tool, right, where you can really pass on material wealth to future generations in a tax-free manner if that's part of your estate plan.
Fantastic. Well, thank you for recapping those. So Roths, they appear to be attractive on the surface, but there are a lot of different things that you need to keep in mind. So what are some of the steps that people listening to this podcast should do?
You should take a look at your current income sources. Take a look at the current tax bracket you're in. Take a look at what you expect your retirement income sources to be and see if any of these, issues or strategies apply to you. And if they do, you can go to our website, wheelercpa.com, go to Ask Wheeler and get in touch with one of our accountants. We can walk you through the process. We can help you determine what's the right strategy for you and see whether you're better off in a regular account or a Roth account, whether you should do a conversion or not do a conversion or any of the kind of things we just discussed.
Fantastic. Well, Matt, thank you for joining us today talking about the 6 key considerations in Roth retirement accounts, episode 8.
Thank you.